Welcome to Retiring Well. We're so happy to have you tune in today and spending a little time learning about planning for your financial future. Starting off the show, John and I are going to be talking about, is it a problem to die rich? Boy, wouldn't that be something, but what is the consequences of that while you're living? Then Leah and Jack have a really interesting segment following that, talking about the benefits of Cobra, specific to healthcare and what that may look like. Then Joe is going to be talking about what to use with an unused 529 plan. Out there, maybe you're somebody that has one, or maybe your children or grandchildren have one. What does that look like and what can you possibly do? Then Ray has got an interesting quick thing about the history of the Federal Reserve, or the Fed as commonly known about. Boy, you're not going to want to miss that. And to wrap up the show this week, Nick is going to be talking about what's your tax bracket. As we kind of get near the end of tax season and that may be on your mind, what do those brackets look like? What can you do to adjust yours or to maximize it? All this and so much more regarding your retirement planning coming up right here on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well. Plan to retire well.
You know, it always seems like things come in trends. My mom always says things come in pairs of three. So that's not pairs, but come in three. But effectively, kind of seems like when you hear something, it comes repeatedly for a while. And one of the things it seems like we've seen quite a bit at the office with our advisors here is folks coming in, and we've been having these conversations about spending money, and there's been a resistance for those folks to want to spend money. And so we kind of start having these conversations and we learn, is it bad to die rich?
Yeah, that's a great question, Art. I mean, it's one that people are always concerned about running out of money. I mean, that's one of the number one fears that's out there in the world today is, I don't want to run out of money. What if I need it? And so that's where, again, I sort of look at this as there's tools available that can help us sort of navigate through that to best try and project what your retirement looks like, as long as you give us some of the information needed to start building that plan. And so if you can have a plan in place where you know, okay, comfortably, I shouldn't be running out of money. I've got, money set aside. I think one of the bigger fears that's out there now for folks is as they get older and everything as well, what about a long-term care situation that could, eat up all of my money, instantaneously. And that's where, again, try and look at it from a certain perspective to see, well, what are the averages and what are the expectations that you might actually have to spend out of pocket in that type of situation. So again, you can't know all the variables, but you can try and figure out as many as possible.
Absolutely. And I think that's having that plan, right? One of the other common things we hear about is resistance to spending some of their money is folks don't want to pay taxes. Very commonly we see folks coming in near the end of their working career or even after they've retired, and the bulk of their assets are in their 401ks or IRA, pre-taxed accounts. So every dollar likely they're going to take as a distribution is going to come in some form of taxable income in conjunction with maybe their pensions or their Social Securities or other forms of income they have. So there was a resistance to want to create taxable income to have to pay the IRS and taxes, right? So again, not going to spend it. They're not going to tax it on me. Well, there's some required minimum distribution rules later in life for most people that you're going to have to start taking it out at some point. But again, kind of to your point, again, that fear of out there, there's kind of a fear of paying taxes. I think contributes to some of it as well.
Yeah. One of the things that I think of is this concept of legacy and how you may want to leave a legacy. And with that, one of the greatest gifts that you could potentially do is during your lifetime, if you're able to build a plan that comfortably shows that you shouldn't be running out of money, well, what about being able to start gifting some of that money during your lifetime so that you can see your family and maybe friends or different charitable organizations benefit from the gifts that you've given to them. And so again, there's strategic ways you can go about that. A lot of times too, from a tax perspective, ways that it could benefit you and benefit them in the long run. And so you want to take those different ideas into consideration information. I know, Art, you had a client recently that you're having sort of this same conversation with, right?
Absolutely. She had called in from the television show a few years ago. We've been working together. She's finally got to that retirement point and down here kind of in the central Michigan area. And, and she's just struggling wanting to spend money. A single individual and has a very nice Social Security because she worked later into life and delayed Social Security. And it's really, her needs are met and she's done a fantastic job saving. But what I've learned with her over the years is there's a mental hurdle from the fact that she's worked 50 plus years working, saving, putting money in a plan, and now all of a sudden that paycheck has stopped. The savings per se has stopped, and now we're in this distribution phase of life, and there's a huge mental hurdle that's just the fact that we're going to start spending some of this money. Now again, she's done a phenomenal job saving, so just the interest alone is growing, right? Even though she's not making contributions, she's enjoying seeing that account balance grow. But again, just that mental hurdle of receiving money versus putting money in.
Yeah, so true, and it's one where it's tough to flip that switch from being a saver your whole life to all of a sudden trying to start spending money. But it's one where, again, here at Centennial Wealth Advisory, we help map out a retirement plan for folks so that they can see sort of year by year, what does that look like, and get a reasonable estimate to make sure that they're not going to die rich. So give us a call. We'd love the opportunity to have a conversation.
Centennial Wealth Advisory invites you to attend one of our informative dinner events. There is no cost and no obligation, and dinner is on us. You have seen us on the Retiring Well TV program, now in its 15th year. Come out and meet us in person. Our live event includes an educational presentation on important financial planning topics. Will Social Security be there when you need it? And what are the keys to optimizing your Social Security benefits? How is the one big beautiful bill impacting your retirement? Are we in a market bubble? Portfolio changes to make now. How can you plan for leaving a financial legacy while continuing to enjoy your lifestyle? Call 888-608-5825 or register online and choose the date and location that works best for you. Tuesday, April 21st at McGee's 72 in Traverse City. Wednesday, April 22nd at the Hampton Inn in Manistee. Thursday, April 23rd at Benetham's Northern Inn in Gaylord. Thursday, April 23rd at Lakeside Charlie's in Cadillac. Tuesday, April 28th at the Perry Hotel in Petoskey. Or Thursday, April 30th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and tends to fill quickly. Call 888-608-5825 or register online to reserve your seats today. Don't miss this important live event to help you plan to retire well.
Thanks for tuning into this segment where we're going to talk about the advantages and disadvantages of Cobra and maybe how we can help you retire early.
So the amount of times that people will come into our office and they'll say, hey, we go through our first introductions and everything, and one of the first words out of their mouth are, well, I can't retire because of health care. And it always piques our interest because we're like, well, why not? What do you know about it? What is your planning? What kind of conversations have you had, with somebody that can go across all fronts, not only the healthcare planning, which, by the way, we're licensed and can help sign you up for Marketplace and for Medicare health insurance, but the other things of like tax planning, income planning, estate planning, risk mitigation. If you don't have an advisor that can work through all of those different silos, people will be left thinking that they can't retire because of health care. So maybe, Leah, walk through one of those recent scenarios of how they're going to utilize Cobra to retire early.
Yeah, so we encourage them to reach out to their employer, figure out if Cobra is an option, the cost of it, and then all of that kind of stuff. So they said, all right, we're going to retire in June. That means we're going to be on Cobra from July to December and then the whole following year. And so what we were able to do is work with our team and figure out a plan that they can maybe do some Roth conversions so that when Cobra has now ended 18 months later, they have the time period that they're going to be on marketplace, and we can keep their income lower for the subsidy.
Yeah, in that example, these clients were 60 and 59. And so age does matter when you're going into that type of Roth conversion strategy. Whose account are we doing the Roth conversion for? And one of the reasons we did that is because by staying on Cobra, we don't have to worry about the tax subsidies and the income limitations that the marketplace plan, has, especially with the new, current marketplace tax subsidy cliff. And so what we did, is, as Leah explained, is we're going to utilize Cobra. Yes, it is a little bit more expensive in their particular situation for Cobra, but by doing that Roth conversion, freeing up these funds, now on these years going forward, while they're on marketplace, we have a tax-free place to pull those funds from so that their lifestyle can still be strong. They can enjoy these great years of retirement, and it doesn't blow up actually the other marketplace income restricted healthcare piece of their planning.
So another client that we had come into the office, they were actually under the age of 59 and a half. So that we had to work with their 401k, figure out how we're gonna take care of that. And we actually ended up deciding, well, maybe let's look at the 72T. So what we did is they stayed on Cobra. We completed their big Roth conversions that made sense for them. And then going into their next 4 years between 55 and 59, we looked at what a 72T is so that we were able to keep that under for their marketplace health subsidy.
Yeah, that's awesome, because then what they did is they had some outside funds, some non-qualified account funds that in that Roth conversion tax planning, we also realized some gains so that they have, tax favored dollars that they can supplement their income, but are not going to impact, like Leah said, those healthcare marketplace tax subsidy amounts of taxable income. And so it was actually a little bit of strategy. Well, I'm sorry, a lot of bit of strategy, because we're saying, okay, here's where our income is. You can't have retirement without income, and you don't want to go through life without healthcare. But don't think just because you are that healthcare, costs limit you in your retirement options. I mean, these are problems that we solve all the time, and we coordinate and we educate to the point of a decision. And so every time that we have somebody coming across the table from us, we get to say, all right, knowing what we know, what would we do if we were in their position? And then we just teach them. And that's an awesome way to do business and to, again, educate. So thank you so much for watching. If you want to get educated on your particular plans, we got offices all over Northern Michigan. Thanks so much for watching.
What can Retirement Analyzer do for you? Retirement Analyzer is a software tool that can help you prepare today for your financial future. You've worked hard to save for your retirement, but as you near your retirement, you may have concerns. Have I positioned my retirement savings wisely? Have I saved enough for retirement, and will my savings last throughout my lifetime? What impact could inflation have on my future expenses? What if I suffer a long-term illness? Will I have enough money to cover my medical care expenses and still be able to meet my other financial obligations? Could changes in the income tax rates disrupt my retirement strategy? There's no need to be in the dark as you prepare for your retirement. Retirement Analyzer can help you find answers to all these questions and more. The first step is providing us with information on your financial assets, the type and current value of those assets, as well as your sources of income. Then, we work with you to identify your expected expenses in retirement. This will include a discussion of the lifestyle you envision in retirement, travel, a summer residence, whatever you dream your retirement will be. We'll input the information you provide us into the Retirement Analyzer, and in a very short time we'll have reports that show us the percentage of assets currently in high-risk vehicles as well as the percent in lower-risk products. Retirement Analyzer enables us to project your income from year to year in your retirement and see how long your retirement savings may last. as we change the conditions of the report, delaying your retirement date, including costs for long-term care, adjusting the expected tax rate, or adjusting your retirement strategies, we can see how changes in these variables may impact your income in retirement and the longevity of your retirement savings. Let the Retirement Analyzer help you test drive your retirement strategy today, because the time to discover the bumps in the road is not once your trip through retirement has begun. Contact our office today to schedule an appointment for your Retirement Analyzer review.
Let's start with the question many parents quietly worry about, and something I get asked a lot as you come in for meetings or grab us on the side of different events is, what happens if we save too much for college? Maybe our child gets a scholarship, they choose a different, cheaper school, or they skip college entirely. Many parents have been plagued by this unknown of, well, if we put too much into a 529 plan and we don't use all of it, what happens? A recent rule change has started to change that equation for us and make these plans a little bit more flexible. And in some cases, what started as a college planning tool turns into kind of a launching pad as a retirement account. So let's take a step back. In 2024, we've all heard about the Secure Act, specifically Secure Act 2.0 that was passed, and that changed a lot of rules for RMDs, retirement accounts, etc. What it also did is it opened up the door for 529 plans. What I'm specifically referring to is it allows us now to convert a portion of unused 529 plans over to a Roth IRA in the name for that beneficiary. Keeping with the tax-free growth, we take this college account and we turn it into a nice tax-free retirement account. So here's kind of the headlines or the main points, and we'll come back to these so you don't have to pause and write them down. The lifetime maximum is $35,000. Okay, so it's not a free-for-all. We do have that maximum $35,000 for lifetime. It's a tax-free and it's a penalty-free transfer, which is fantastic. It does have to follow the Roth IRA contribution rules. So we have to have earned income, and we can only contribute up to the annual contribution each year up to that lifetime maximum. So again, there's some fine-tuned rules here. Also, we have to have that plan around for 15 years. So if we just started it, not going to be available to us. It does have to exist for a certain period of time. But it does start to give us a backup plan and answer that what if question of what if we don't use all of those plans? We do now have an option to move these funds into other positions. So let's kind of think about the math for a second. So if we graduate college, say we're 22, we have this unused 529 plan, we slowly convert this over to a Roth over a few years. So let's say it's done within, we'll say by 25, and our retirement goal is 45. Well, we have a very long period of time that this money can kind of season there in that Roth account. And if you assume an 8% growth rate, that account could potentially turn into close to $1 million without ever having to add contributions to it, simply taking advantage of that compounding growth. To me, that's powerful. Okay, so again, let's take a step back. What are some of the rules around it? Just kind of recap. Well, one is we have to have that seasoning period, right? It has to be around for 15 years. We have to have that lifetime and annual contribution number to be aware of. And we have to also have that earned income component. So it's not, again, a free-for-all or unlimited, but it does give us some options. Now, there's other things we can do with the unused 529 plans. We can always move these plans and change the beneficiary to siblings, other grandkids, cousins. We do have some flexibility. Over the last few years, they have really changed the rules on these plans, and they've made them a lot more available in how we can use the funds. So you can use them for trade programs, you can use them for certification programs, apprenticeships, even continuing education. So for me, as an example, I have my CFP certification. When I went through that program, you weren't allowed to use 529 plan funds, but those are expensive programs. So if you have kids or grandkids working on a CPA or their CFP or CFA or whatever alphabet soup of designation you want to pick, you can actually use these planned funds to pay for those programs, which tend to be pretty expensive pieces to it. So the real takeaway is, when we're saving for kids' college, there's often this battle of saving for college or retirement. To be clear, retirement planning still comes first. However, there are loans we can take for college. We can't really take loans for retirement. But this new rule allows us to use these 529 plans and potentially jumpstart retirement planning for the next generation. I almost think of it, it's kind of morphed into this multi-wealth planning tool as opposed to simply just an education planning tool. And I don't know anything that you don't know, but I do think that they're going to continue to broaden and change these rules and make these plans more expensive or more flexible because of the rising cost of education. So if you're saving for a grandchild or a child, the conversation around 529 plans, in my opinion, has changed. Worst case, it helps pay for higher education costs. Best case, it helps launch the retirement planning career. And that might be one of the biggest gifts you can potentially give. So if you don't know where to get started with education planning, or you don't know if these 529 plans really fit into your goals, well, it's a great time to come in to sit down with us. Let's review your financial plan. Let's talk through your goals and see if these 529 plans maybe are worth revisiting based on some of these new rule changes. Or come to one of our dinner events or webinars. We have a host of videos on YouTube you can check out as well for more information on how to use these different tools.
Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, and to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
Over the last several years, you've probably heard one of the bigger market stories involving the Federal Reserve, often referred to as the Fed. Now, the main focus of those stories has been interest rates. Is the Fed going to cut them, or is the Fed even going to raise them? Today, in our money market segment, I'm going to be looking at the history of the Fed and what it's done during economic events in our nation's history. The Fed is the central bank of the United States, so its core responsibilities are to conduct monetary policy, supervise financial institutions, maintain financial stability, and also provide payment services. But the Fed hasn't always been around. So for decades, America operated without a central bank, and it wasn't smooth sailing. Now, in the 19th and early 20th centuries, those were marked by repeated financial panics, like bank runs, market crashes, and economic chaos. But the tipping point came with the Panic of 1907, when the financial system nearly collapsed. Now, that crisis convinced lawmakers that the country needed a more stable and structured system. So in 1913, President Woodrow Wilson signed the Federal Reserve Act into law, creating the Federal Reserve System. So the Fed is designed with a unique structure. Now, they have a board of governors that's located in Washington, D.C., and then there are 12 regional Federal Reserve banks spread across the country. So this setup was meant to balance the national oversight with regional input, and to avoid concentrating too much power in one place. Now, over time, the Fed's role expanded mostly due to economic events in our country. So first, there was the Great Depression in the 1930s, where the Fed faced criticism for not doing enough to prevent bank failures. In response, the reforms strengthened its authority. And then between 1965 and 1982, the United States experienced the Great Inflation. So to combat this, the Fed's chairman raised interest rates to unprecedented levels in 1979. A deep recession resulted, but prices eventually then stabilized. And then decades later, during the 2008 financial crisis, the Fed again took aggressive action, cutting interest rates to near zero, and also introduced emergency lending programs to stabilize the economy. And then lastly, during the COVID-19 pandemic in 2020, it moved just as swiftly, slashing rates again, launching massive bond buying programs, and then rolling out emergency programs to support businesses, local governments, and financial markets as the global economy came to a screeching halt. So, as history tells us, the Fed is essential for maintaining our economy. And more than a century after its creation, its decisions still shape everything, from mortgage rates to job growth, touching the financial lives of nearly every American.
Centennial Wealth Advisory invites you to attend one of our informative dinner events. There is no cost and no obligation, and dinner is on us. You have seen us on the Retiring Well TV program, now in its 15th year. Come out and meet us in person. Our live event includes an educational presentation on important financial planning topics. Will Social Security be there when you need it? And what are the keys to optimizing your Social Security benefits? How is the One Big Beautiful Bill impacting your retirement? Are we in a market bubble? Portfolio changes to make now. How can you plan for leaving a financial legacy while continuing to enjoy your lifestyle? Call 888-608-5825 or register online and choose the date and location that works best for you. Tuesday, April 21st at McGee's 72 in Traverse City. Wednesday, April 22nd at the Hampton Inn in Manistee. Thursday, April 23rd at Bennetham's Northern Inn in Gaylord. Thursday, April 23rd at Lakeside Charlie's in Cadillac. Tuesday, April 28th at the Perry Hotel in Petoskey. Or Thursday, April 30th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and tends to fill quickly. Call 888-608-5825 or register online to reserve your seats today. Don't miss this important live event to help you plan to retire well. If you like watching Retiring Well, make sure to go to youtube.com/retiringwell and click the subscribe button to never miss any of our TV shows and other informative videos.
Do you know your tax bracket? This is often something a lot of people just misunderstand, okay? They just don't have a firm grasp or understanding of our tax system here. So in the US, we have what's called a progressive tax system, okay? So what that means is that your income is broken down into different portions, okay? And each portion is taxed at a different rate, okay? So the first portion or tax bracket for a married couple runs from $0 or $1 all the way up to $24,800. Okay, that first portion of your income, first tax bracket, is taxed at 10% for a married couple. Then the next portion of your income, that is what we call your 12% bracket. That runs from $24,801 all the way up to $100,800, okay? And this portion is taxed at 12%. But where a lot of people get this misunderstanding is if they bump up into tax brackets, they think, well, that makes all of their income taxed at that higher rate. And that's just not true, okay? So based on this progressive tax system that we have, only the portion of income that falls into those different tax brackets are taxed at that specific rate, okay? So why do you need to pay attention to this? Well, if you're a planner, okay, you wanna make sure you're aware of different, deductions, credits, and contribution strategies so that you aren't paying more than you should in taxes, right? Nobody wants to pay Uncle Sam more than they have to. You wanna keep that money in your pocket. So I'll ask you again, do you know your tax bracket?